So Sean Hodgins has been giving this talk on financial models for quite a while now, and he's also been a judge in the competition, and he's also been in the competition. So he can speak to you about the competition from several different angles. And I also feel he has a rare talent to be able to make financial models interesting and easy to understand. So I think we're lucky to have him. So Sean, thanks again for joining us, and over to you.
Thank you very much, Angie. Always a pleasure. So yeah, I've been in this game for quite some time. I'm a CPA. I originally came through Deloitte, Vancouver during the whole tech bubble, and then went down to the Bay Area, got my CPA with PricewaterhouseCoopers in the Bay Area, and then moved back with a real passion for working with startups. And the New Ventures BC program is just such a fantastic program, and I really ideally can contribute some insights and ultimately really good financial models, because it does seem to be a common thread, and maybe it's me. So in terms of getting the submissions to have really good financial models. So we'll dig in. I'm going to try to leave as much Q&A time. I think that makes it a little bit more interesting to get people's questions and then some feedback loops. Also interesting is my history of actually investing into a lot of early stage companies. And in the last couple of years, we started Red Thread Ventures. I myself started to invest in some of those clients that I was working with in this ecosystem, and recognizing that, hey, these are fantastic businesses. And I think that's a part of this journey. How I approach the financial models is very much as an investor. Like, what is an investor looking for? How do you make this interesting? Because generally speaking, good old CPAs and financial statements, they can be a little boring. And this is a little bit of how to make this really more interesting and more compelling to an investor. So that's a little bit of the theme from my perspective. So as we start in, so just words of wisdom as being a participant in the competition. You know, it's a great experience. There's so many people tied to the network that are invaluable. And I think everybody that you can interface with will be very positive and try to assist you. I mean, that's the best thing about this program. You should learn a lot. Don't worry about winning. Like, we didn't win, but that wasn't a big thing. The learning experience was fantastic. And to this day, the company we brought through, like, one of the judges said, if this is so good, why don't you use it to run your accounting practice? In fact, that technology that we brought through is now the foundation of a very large accounting bookkeeping practice, and is still running today, however many years later it is. So a little bit of just tidbits on your submissions. Just get a really good editor. Keep it clear and professional. These are just little things that should be easy to address. Be real. Use case examples, and that overlaps in the financial model big time, because making it understandable is half the battle. Usually you may have a real deep domain expertise in some area, and later on here I talk about the concept of a TED Talk. That's what we've seen with the companies that we've been investing in. I think we made like 7 or 8 investments this year already, and that is a common theme. Somebody who's really knows their area really well, has a fantastic team, knows their numbers, and has the ability to articulate their story, typically with numbers involved, in a way that's extremely compelling. So be confident in yourself and your story. These are all the essentials, and kind of reinforcing the importance of these financial models and building your business in Excel first is so very important, because if you can't explain how you're going to make money at the end of the day, that's what investors are mostly interested in. The marketing, the go-to-market strategy, the problem, they're obviously extremely important, but understanding at the end of the day how you're going to make money is the essence of financial modeling. So that's it. And finally, don't be afraid to ask for help. That's a part of this journey. And I wish you all the best and success on that front. So turning to financial models. So there's just a little bit of vernacular that you need to understand. And what is a financial model? So this would typically include what are called projections. Some people call them pro forma financial statements. And this is your statement of profit and loss. And ideally, you might have incorporated your business very recently or be planning on incorporating your business. Typically, what an investor would be looking for in your deck is your historical financial performance, as well as 3 to 5 years in the future. In Excel, what do you think your business is going to look like? And so this is an extremely important place to start in understanding that challenge. And I will say, you don't need to be an accountant to do this. The best financial models that I've seen have come from engineers, interestingly. There's some amazing companies that have grown up here in the local ecosystem. And that's the commonality is the ones that I know. They really know their numbers and they've planned it all out in Excel in advance. Okay, so in this does help everybody understand where you're financially taking the company, and ultimately is why somebody would invest in it. You do need to follow some rules. So indeed, having an accountant involved in the process, vetting it, making sure that your core assumptions make sense and ultimately produce generally accepted accounting principle-based financial statements, or IFRS. These are terms that you'll run across. Don't be afraid of them. They're just common. And indeed, at some stage you may get audited, and your financial statements would need to comply with that. Usually your financial modeling should be a little bit more understandable, just the nuts and bolts of how you make money, but it does need to reflect in your materials where you think this is going to go, and it should comply generally with a set of generally accepted accounting financial statements. Okay, so there's really 3 sets of statements that you need to have. That's a balance sheet or a statement of financial position, as it's called under IFRS now. And this is really what's the state of your financial position today? How much cash do you have? What are your receivables? How much is your shred receivable? How much is your GST receivable? Little points that we'll touch on. Minus how much liabilities do you have? How much do you owe, your law firm for incorporation, your accruals to perhaps some of your startup employees or consultants, et cetera, as well as then how much have you raised in equity. And that, at the end of the day, your accountant will make sure it balances. And that is an extremely important financial statement. And it will also need to be projected out into the future, because that will be a point in time where you'll see where you run out of cash, et cetera. These statements overlap with your profit and loss statement. So this is your, over time, what's happening in your business. Are you generating revenue to bring in income from customers? Are you getting government support income that isn't necessarily revenue, it's other income, minus your expenses, payroll expenses, consulting fees, legal fees, accounting fees, et cetera. And then the other one that is really important to investors is cash flows. And the interchange between the balance sheet and your income statement will reflect your cash flow, because your income statement, your profit and loss statement may not always reflect what your cash flows are. You may sell something today and not collect it for a month and a half, right? These are common working capital issues that you as a business owner need to understand the implications of all of this as you're setting this up. And once you have these financial models in place, it's showing a certain level of sophistication. And really, that's what the financial model should be demonstrating to your investors, is that you actually know how to run a business. So build it from in Excel. There's a concept of bottom up and top down. I think most people like to build models from the top down. Oh, we're entering into this billion-dollar industry and we're going to get 1% or 5% of it. And this will turn out to be this much revenue. Those are not the best models. And yet they're very, very common. So what you really need to do is take the time to build your model from the bottom up, meaning what are the pieces? What's the segment of the market that you're going to go to? I like to build models with your first 10 customers or even 20 customers in mind. And of course, every financial model will be different in some circumstances, and we'll talk about the different kind of financial models shortly. But that's the granularity investors like to look for. And that overlaps with the comment I said earlier about a case study. Investors like to get into the sense of understanding what the problem is, what is the solution, and then a case study. How are you going to sell this to your first 10 customers? Who are those 10 customers? How do those 10 customers fit into your multi-billion-dollar industry? Why are they particularly aligned with your solution over someone else? And having these financial stories readily available and very well understood is so very important. So that's why you need to take the time in Excel to build these bottom-up type financial models, okay? From there, you'll also get non-financial information like KPIs, key performance indicators and milestones, like what's happening in the industry that is pertinent to you and your business. And investors like to see that. That shows that you understand the nuances of the industry you're in and exactly how you're going to execute in a way that will ultimately produce revenues, expenses, etc. So those are, even in the Guy Kawasaki slides that we would say, he's got financial projections, which is everyone's kind of hockey stick of sorts, but it's the KPIs, these key performance indicators, what's going on here that will really help people understand your business. Okay, and valuation. And this is an art form of sorts. Everyone thinks they can hire a chartered business valuator. You put your financial model in there and it spits out a value. Now there's some truth to that. And there is some level of simplicity that value really is the present value of your future expected cash flows, right? So that does become a very important component of your financial model. If you expect to support your valuation, then you have to have a model, or else it's really, you're taking any sort of science out of that. And if you have a good financial model that's very believable, that says, okay, today we're a startup, but in 2 or 3 years, we're going to have revenues, top lines of this amount, and this is where we're going to incur our costs. And at the end of the day, we will be a profitable business. This becomes the foundations to which your valuation is made, okay? So these are all of the critical components to making a great financial model. Okay, so key terms, I mentioned already, this GAAP and IFRS, non-GAAP items. Those ones I think are self-explanatory. Another important one is the difference between revenue and sales. And this is putting the accounting hat on or off and understanding the essence of startups is that you have to sell first. Like you have to sell your product or service or SaaS solution or your NFT or whatever it is that's in your business. You have to sell it first. And selling it does not mean revenue. It means that they've committed to buying it. You may then have to deliver it. You may have to spend time making sure that it works properly with these customers. Early customers may be freemium. We just want to give it away so that we can get feedback from customers. None of that is hitting your financial model, it's not hitting your GAAP financial statements, but it is very, very important to your financial model. So that's why I'm throwing this out, is just understanding the nuances of selling versus recognizing revenue, meaning we've now delivered something. We can send them an invoice or take a payment on their credit card, and ultimately collecting the cash as well, which is even a secondary thing. So when you sell them, You may give them terms on when they pay you. So another essence of another factor in running a business. Okay. So the other thing you'll hear about is like, what's your burn rate? And this really just means what's your net cash expenditures per month? How much are you spending on your employees? Rent, not that everyone has much rent these days, but that's an important number that you have to have readily available so somebody understands how you're operating your business month to month. Spend maybe something different. You may have capital expenditures. You're building something first. We're working with an investee company right now that's building out a lab space, for example. So they're going to incur a lot of costs in just building that. So you have to understand what your spend is. Okay. Runway, very, very important to startups. How many months until you run out of cash? Okay. So everyone, these are questions you get asked in the elevator or certainly in your investment materials, is understanding all of these things. EBITDA, okay, earnings before interest, tax, depreciation, and amortization. It's a bit of a mouthful, but this is translating accountants' IFRS financial statements, or generally accepted accounting principles, into something that's a little more meaningful. How much cash are you generating or losing from the core of your business? So this is a number that you should get comfortable with that's translated out of your financial statements. Okay, and it's basically removing any interest payments or non-cash expenditures and tax so that somebody knows, again, roughly how much you're making or losing, burning. Then post-money value, pre-money value, these are common questions that you'll need to understand, and they overlap, as I said, with your financial model. So post-money simply means how much is the company going to be worth after you've raised the round that you're incurring. It's the per share price times the total outstanding shares that you will have after you've raised the capital. And pre-money is that number minus how much money you raise. Pretty simple. Okay.
Oh, hey, Sean, Sharon is asking, what does the exercise cash stand for? I didn't see that there, but.
Not sure.
Okay, Sharon, maybe just clarify, and then in pre-money.
Oh, subtract funds raise. Oh, good question. Sorry, I missed that last bit. So that's applicable if you have stock options or warrants, meaning if you have dilutive instruments. It's a little bit complicated. I should probably remove it for this audience, but some companies may have some stock options, and that just is an adjustment to your pre-money if there's any in the money stock options. A little bit complicated, but good question. That's a very good question. Okay. So good financial modeling. Start one with the opportunity analysis. And this is the top looking down. Like, what is the industry sector? And you'll usually see that on the opportunity slide. Like, what's your industry? We're in this sector. It's, $4 billion at this CAGR, growing at this rate. So you do need to understand that, but it's telling the story down through the meeting of the top down and the bottoms up model here. And step 2 is carving out that opportunity in a way that's very understandable. Who are the specific customers? And generally, I always say, get some case studies. Pick a customer where your problem really resonates and walk through the whole cycle, exactly how you're selling it to them. How long does it take to sell? Some customers are complicated. They're businesses, they're government. Expecting to sell something quickly to those organizations is unrealistic. Or it might be a consumer-facing product and they'll buy in a minute just because they like the value of what you're selling. So understanding how you sell things is important. And then how does this translate into revenue? Well, some things are more complicated. You might be selling a license to use your software over a period of time, or a SaaS product, a monthly subscription. And you might charge them a year in advance. Well, what does that mean for revenue? Does that mean you can recognize all the full year's subscription in advance? No, it doesn't. It means that you have to recognize it over the entire year in your profit and loss statement. From a cash flow perspective, it may mean you get all the cash in advance, and that's an important thing. But understanding these interplays between what it is that you're selling, how you're earning what you're selling, and how you're collecting the cash is all very important to make sure that you yourself understand, and that conveys to investors that you understand how you're going to run the business. Okay. Gross margin is always, in my mind, the most important thing really in a good financial model. And we'll look at some examples of financial statements where this really pops out. This is the essence of the investor's opportunity, that you have identified a problem, you've built a solution, and that somebody's willing to pay you more than it costs to deliver to them. Well, how much? Okay. Is it a retail play and you're getting 25% at the end of the day, 50% gross margin? Where are all the costs? Is there markups? Are you a wholesaler? Is it a SaaS solution? And there is no middleman or anything like that. It's just software that's subscribed for nearly 100% gross margin, some Amazon costs plus, transactional fees. That's it. So the gross margin is really combines the problem and solution in a way that's translated into financial performance. Okay. And then it goes into, okay, well, how do we get there? How do we get to the point of selling, recurring, or arriving at profit, and understanding all the elements of selling, right? So it might be cost of customer acquisition, marketing costs, all the relevant things like social media statistics are now very pertinent in startups. You might not have sold anything, but if you've got 100,000 followers that are signed up for your beta, well, this is really interesting, right? The likelihood of them translating quickly to being paid customers, if they're already signed up for your beta, is very high. So these are KPIs. These are important, pertinent information that comes from the marketing side of your story, but is very much part of your financial story. Okay. Case studies, I've kind of beaten on that a little bit here already. Believability, that's the art of this exercise, is telling a story that makes the investors really buy into what you're selling. So a little bit of best advice is try to find investors and target to investors that understand what you're selling in the first place. But for this competition, I strongly recommend that you do a TED Talk style, which is dumb it down. Okay. I even say that every day when we're talking to prospective investee companies, dumb it down. And I play the dummy. It's easy to do for me. That's no problem. But what that does is it allows you to connect in a really meaningful way with everybody you're talking to get them to buy into your solution. Really understand the problem, why they would want to purchase what you're selling, whatever it is. And you need almost a case study to bring this into this concept of believability. So I think these are all the things that if you can really nail down, your story, your financial models will come to life. They'll be meaningful. Otherwise, your investors just kind of gloss through the financial slide. And that's what I think people mostly expect, is that, oh, it's just a hockey stick slide. There's nothing here. And that's sadly missing the point. So I'm emphasizing this. Here's a great example. One of the companies that I've had the pleasure of working with and investing in. And in my mind, this is one of the great simplifying a very complicated financial story. When I first ran into Matza, which I think was a top 3 finisher in the New Ventures BC competition many years ago, they had developed a proprietary technology up in Summerland called pressurized low polarity water. This is a very complicated technology. I think the first investor deck that I saw was about 45 slides. It was very hard to necessarily understand what the business model was here. So it took some time for us to figure it out a little bit. And we got it down to the point of this almost an elevator pitch that we could go out to all the cranberry farmers in one product offering alone. And after the ocean sprays of the world take the cranberry juice out, they're left with what's called pomace. And lo and behold, this pomace that's at best sold for fertilizer or an additive for pet food at best, has this amazingly valuable compound in it, and that we could buy a ton of this stuff for about $1,000. Okay, then we use this PLPW technology to extract what are called proanthocyanidins from this pomace. And you go onto Alibaba and you find out what this can sell for. And suddenly the business model makes a whole lot of sense, that if we can take 1,000 kilograms, add some energy and water and a proprietary piece of equipment, which was a little bit expensive to produce, we could produce 42 kilograms of 8% proanthocyanidin that would sell for about $6,000. This is a very simple story. And I think if you think about it a little while and look at the numbers, okay, that is pretty impressive gross margin. Now it's just a question of all the KPIs to scale this. And this is what I'm talking about, trying to get what could be a very complicated story down to some simple financial numbers so that an investor can understand the potential. So this is why I keep coming back. Every year we run into some really neat companies, and there's a few I'll talk to, although I'd really like to open it up to the floor here as quickly as possible as I keep an eye on the time. So, yeah, a little bit of this is repetitive. So we talked about this billion-dollar opportunity. Reference your sources. So actually a company presented this morning to our network, and it was make sure that you have backup for your numbers, especially industry opportunity size. Make sure that if you're putting numbers out there, they're easy for somebody to go, yeah, that sounds reasonable, or if they're specific, that you have a reference. So somebody can validate that your number is correct. It just shows a little bit more professionalism that you've referenced your sources. Okay. And then this story of, we're going to get 5 to 10% of the market. Everybody says that. Okay. So that's why you need a bottom-up story. You need to be able to explain, well, yes, this is a huge industry, but there's a particular niche over here that has a really significant problem. We've been in this business for a while. We recognize this problem. And then we think there are a certain number of similar companies, and we'll slowly chip away. Oh, and if we have some of these successes along the way, then the person is arriving with their own calculations on that actually equating to 5 to 10% of the market. This is the story that's often missing and that you really need to focus on. The why. Why do you think that that's going to get there? And show the numbers to support it. It can't just be a cooler product, cheaper. All of those things are essential, but you have to translate that into numbers, okay? Growth rate, sensitivities to being unrealistic, okay? We see them lots, and you have to keep it sensible. Best case, worst case, here's our assumptions, okay? That's always the best way to present financial models, is some recognition that it's unknown, right? Don't be foolish with your projections. They also are subjecting you to some level of risk. You're telling investors to invest today on some of your assumptions about the future, and that comes with risk. So it's best to give them a range. Try to lean towards the conservative end, although don't use that term. So often I see presentations, and these are our most conservative numbers. Just don't go there. Just present your numbers and perhaps have those scenarios so that the investor themselves can make judgment. Okay. Competitive advantages. Now, these do need to translate and will be a very important part of your story, and is truly the more interesting part of it. The team, what's the experience? How committed are they in terms of, do they have some skin in the game on equity or stock options to bring their salaries down? Is it shreddable? Have they done it before? All of these things correlate to some financial number. Okay, this person has a proven history of selling, $50 million a year in some SaaS product, whatever it is. These things almost always have to translate into some sort of financial story. First mover advantage, patents, all of that means something. That means more gross margin, right? If you have a patent on something, that should directly show that, okay, we have a patent here. That means we should be able to charge more, or somebody's going to have to work their butt to work around our patents. Or it's truly novel, right? There is nobody out doing that. Well, if you're truly novel, be ready for your gross margin to degrade unless it's patentable. So build that into your model. You might get great margins today, but be aware of how you're going to fend those competitors off. What are the implications to your margin? Does it mean you're going to have to add functionality or other things? All of these things translate into some sort of financial model story. Okay, and traction. We're all Canadians having to do generally startups in a much more, it's much harder in Canada than in the United States, where I think there's more capital thrown at ideas. So I would encourage everybody to really think through, make sure you've got traction from at least what I'm talking about, like knowing who the customers are. But at the end of the day, if you actually can get real traction and prove your numbers, this becomes very investable for anybody, anywhere. Okay.
Oh, hey, Sean, someone had a question on margins. Do you want me to ask you now? Or
yeah, please do.
Just asking for general guidance on what's deemed a good or not good enough gross margin.
Sure. Well, it really depends on what industry you're in. So I hinted a little bit to like a consumer product. If you're selling something on a shelf somewhere, then the margins and high volume, then 25%, 30, 35% may be entirely reasonable. It depends on how competitive it is. It might be dependent upon whether or not you have some patent protection, right? If you have a product that's on a shelf with a whole bunch of other competing products, then your margin will have to be competitive. So the issue then comes down to what's your volume? That may not necessarily be a problem. Likewise, you may be in an industry like a software solution, a SaaS solution, where there's very little costs to deliver the product. The costs are incurred in selling the product to begin with. Those margins should usually be north of 95%. In fact, we had a company 2 or 3 days ago present amazing business in the SaaS, and they didn't use their costs. They'd use their sales costs as a part of their cost of sale, and it really shouldn't be. Those are your marketing costs. Your cost of sale is really the cost that it occurs on a variable basis every time someone purchases something, right? So if somebody's subscribed for your monthly software package, the margin will be extremely high, and that's what's acceptable. In a retail story, the margin might be quite lower. That's because there's so many other tiers of cost, and it might be just a much larger scale. So the answer is it depends. It really depends on many other factors. The issue is you need to be able to explain why your margin is what it is. And at the end of the day, if you can sell enough of it, it could be extremely viable and very exciting business. So that's more of what's important. Doesn't necessarily we have, of course, everyone likes to see larger margins. And that usually means, oh, I've got a patent or I've got some other competitive advantage. Those are important, but it is a complete package. That's where the financial statements actually serve as a way of bringing the whole story together. So that's a good example of that.
Great. Sorry, there's a couple follow-ups to this now. Quickly, when you're talking about SaaS gross margins, it sounds like you're excluding wages. Is that true?
Absolutely.
Okay.
Yeah.
And then another one, you mentioned about being novel and how your margins will go down. What about networking effects? Or network effects, maybe.
Can you give that to me one more time?
Yeah. It's from Rob. You mentioned about being novel and how your margins will go down. What about networking effects?
I'm not sure what he means by networking effects.
Okay.
I was just simply using the example that first mover advantage may not last long. If you truly have something novel, then expect competitors, right? And that means that you've got to do something about them, or accept them, which means if you lower your margins, you're going to fend away customers. Alternatively, maybe you're going down the direction of building out a bigger network of contacts or marketing something different. Like there's a lot of other things that you can do to address that. I was just simply using the idea of lowering, and you may proactively decide to lower your margin to fend away competition. That's not a bad thing, right? As long as there's a story behind your numbers, and that's, I think, a bit of the big problem for many people is not being able to translate the verbal story, the pitch, into a number story. So, and it's complicated, right? These little things are complicated. They're all intertwined, but it's important. I don't know if I answered the question, but I give it a go.
Okay, I think that's good for now.
I think what's on the slide here is very much along the lines of what I'm talking about. Why should the customer buy your product? This is very much your problem and solution slide, but encompassed with the concept of what's their internal rate of return. Like if I agree to buy something today from you, I expect to save some money, save some time. That is kind of flipping the financial story over to your customer, right? If you're introducing a product that can save them a lot of money, being able to explain that financial story to your investors, hey, our customer is coming to us because we're going to save them $100,000 a year, or whatever that is. That is the essence of an extremely powerful financial model story, right? And it's not your financials, it's their situation. So I'm getting ahead of myself. So we've covered gross margins quite well, although those questions may cover off here. This is really dumbing it down a little bit to just, a widget, right? How much does it cost to deliver it? Sorry, there was a question about services, like how much payroll costs relate. So there are circumstances, of course, where payroll is a part of cost of sale. Service revenues, for example, accounting, right? So you bill them the amount of time it takes to deliver, that's payroll costs. Of course, those are a part of the cost of sale. For SaaS, like software products, usually there might be some customer support, but generally that's bug fixes. It's not on a client by client basis. Those ones will tend to have very little payroll related costs, as well as, you might offshore all the assembly of some widget that you're selling on Amazon, and there's no payroll related costs. It's just drop shipping, and the cost of sale are exactly what you're paying out of pocket to have it manufactured, minus any cost of delivery. That's it. So it is important to understand these elements of your gross margin in a way that's extremely easy for somebody to understand that. The economies of scale is another very common story, right? You're starting today selling a few things to prove it actually will sell, right? But hey, if we were to build 10,000 of them or 100,000 of them, well, typically you'll see huge price improvements on your cost of sale. So that's building economies of scale stories into your financial projections, but being able to speak to the numbers. Hey, we have this order, we have a supplier in China or wherever your manufacturing is, or wherever your partners are, they've agreed to do some, initial runs or orders. This is the price, but they've given us preferential rates if we can get to these scale sizes. Having those numbers known in advance makes your story much more interesting to investors who want to see an exit, 5 to 10 years out, or whenever you truly do achieve your potential. I think that's kind of it on this slide, but if there's questions coming through, and we're almost to the point where we can turn to some questions.
I've got one bigger question just around what to focus on in the round 2 financial question, but maybe we can do that at the end.
Sure. These are a few more just specifics on the KPIs. What are common things that people would look for? Customer acquisition cost, CAC, churn rate, customer satisfaction rates. These are things that you need to think of in advance. Recurring clients, repeat clients. These are extremely important measures to an investor, right? Do you know how much it will cost for you to acquire a customer? How long does it take? What's the satisfaction? And that having some failures out of the gate is never a problem. I've been involved with companies where we learned so much from the first customers, right? They're almost always like, oh, well, it doesn't work quite the way we want it. But as long as you're accommodating, you just need to make sure your financial models reflect reality, right? Oh, we're selling at this. Actually, in the first few years, we might have, or maybe not use years, maybe the first 6 months, we're going to give them a very deep discount to what because it's strategic. This customer, they have a big problem. We're going to sell it to them almost at cost just for the feedback that they're going to give us, so that we can truly ensure that customer number 2 is satisfied. Because if you're bringing customers on and they're not satisfied and they're churning, meaning they're leaving, bad. That's not good for your valuation. It's long-term problem. So what you want to do is plan for that in advance, right? Don't expect it to be perfect out of the gate. It never is, okay? So renewal rates, lifetime value of the customer, exit values, these are just common vernacular that you'll need to understand. When are you launching your product? Everyone can almost spin up overnight a beta or a beta launch. When will you break even? What's the volume of sales in order for you to cover your monthly burn? That's your break even, okay? And everyone wants to know that, okay? The other little pet peeve out there is you raise money just to get to your second raise, okay? It always bothers me with those stories, because it adds such a huge element of risk, right? Try to build models that get to break even, which means at this level, we could be sustainable, if not perpetually profitable, never need to raise another dime in our lives. And all of the investors are going to be happier than, what? So try to build a model that gets you there, okay? Gets to the point. Now, if somewhere along the line, you're growing so quickly and you could grow faster and you're taking on series A, B, C, D rounds to do that, that's fine. But build a financial model that gets you over the line to success, okay? Long-term self-sustaining profitability. Now there's, depending on the business, but most businesses would apply from what I've seen through the competition, okay? Values the sum of the parts, right? Translate these team, the technology, the opportunity into numbers. I kind of explained that before, but try to think as you're doing each section of the submissions or your business plan or your executive summary. How does what am I writing here translate into a number in our financial model? Because it's those stories that make great financial models, okay? And at the end of the day, generating huge long-term cash cow type will generate huge value multiples. Okay. This might be a nasty slide to look at, But this is the essence of the financial model that you would need to put together, in my mind, to do good P&L. So this is a statement of projected profit and loss. The 2017 through 18 are actuals, right? So show your actual performance. That's the best indication of the future, is how did you perform in the past? And you may be changing your business. Don't shy away. You might have hit a point at where you're pivoting, but some sort of traction in history is valuable. And if anything, it shows some level of sophistication, right? Even if it's 6 months of history that you can show, hey, we didn't make any money in the first 6 months. Most companies don't, but we know what we're doing. We have operating losses. We lost money like everybody else who starts a business, okay? Then the value comes into the projections, okay? This darker green, again, it's a little bit hard to see. And what I've shown here is breaking out. You can see that the cost of sale, like the sales and cost of sales, is half of this model. And in fact, the stuff at the bottom here is actually not even P&L. It's more like KPIs. The bulk of your story really should be in what you're selling, like revenue. Are you selling different line items? So this is an example of software subscriptions with training and events, and then some contract development work. So you might be selling multiple things. You could also dissect this in a different way. You might have different product offerings. So doing a deeper dive into what you're selling. And then you have your cost of sales for each one, and then your gross profit. And then what I'd like to highlight are these margins. Like, what's trending here? What's going up? What's going down? How are the margins changing? Don't make these numbers too crazy detailed or too unrealistic. This is what I think most really good financial model investors, and most of them are, like to know the numbers very well, look at this and really want to know what you're thinking, okay? And the ability to articulate your story that allows an investor to understand or truly believe that this is achievable is the real art of doing this well, okay? All of these costs incurred are just matter of fact. They should correlate to reasonable expenditure. If you're selling more, you would expect to have more sales and marketing costs, right? If you're developing new product offerings in the future, your R&D costs will go up. In Canada here, we want to see the offset of your NRC IRAP support grants or your NSERC money or your SHRED. So these are the things, and the best way to reflect those. Do not include those in the top line. They're not generating the core of your business. These are offset subsidies of the Canadian government. So that's the way to do this well. Although this is the detail, you'd want to translate this into your hockey stick slide with some of the ancillary KPIs that would help support this story. But anyone doing serious due diligence or a part of this competition, you will need to submit this at some level of detail. And the story behind all these numbers is almost more important than the numbers themselves. It's this making sure the story makes sense with the numbers in front of you. Here's just a rough example of a runway. This is just your future. How much money do you need at certain points of time? What are your critical milestones? Your ins and out of cash flows is really all that's being reflected here. Yeah, I'm gonna pretty much turn it to Q&A. I think I have a couple more slides, but it'll mostly be ideally Q&A. So keep it simple, stupid probably speaks to this kind of TED Talk strategy. Dumb it down, make sure Sean would understand it. Treat anyone that you're in as though not completely stupid, but just in a vernacular or a language that would help somebody understand your story, okay? Make it interesting, okay? Tell an interesting story. It's this TED Talk style. Find a comparative public company, okay? Go to cedar.com today if you've never been one. Accountants, of course, go there all the time. These are public companies. These are the repository in Canada and CEDAR and EDGAR at the sec.gov site of every public company in North America, or any US listed company, any Canadian listed company. And you can find a comparative financial statement, and you should find a company that might buy you one day, right? And then produce financial statements that would be really easy for them to acquire, right? And show the numbers that reflect to their story. So this is very easy. You don't have to be an accountant to do this. Just go find stories, look at their prospectus documents, look at their stories, look at their financial numbers. And this gives you a huge one-up on how's your story going to relate? Because most investors try to put you in some sort of a bundle. What industry are you in? What's a comparative company? How do you compare to this company? So this is a great way for you to start. Okay, know your numbers, have them off the top. Presentations where the CEO knows their numbers so well are just so compelling, are so good. And use Google. Okay, don't put anything in. Expect when you're pitching that your investors on Google, checking everything that you say. Okay, so make sure you've done that and put the references in directly. Make sure you have supportable numbers, supportable financial statements.
All right. Thank you, Sean, for the rundown, quick rundown. I'll try and run through as many of these questions as I can. So first question is, as you know, because you review a lot of round two, it's the financial question is just one part of a kind of 4-page submission. So knowing the parameters of that, what key terms should be discussed in the financial section? What's enough detail without being too detailed?
Yeah, I think it's really encapsulating this gross margin story with an overlap to the future. Like, what does years 2, 3, 4 look like in a rational way that ties up to the section on go-to-market and your marketing strategy? Those are, in my mind, what's critically important in the financial model is believability, and that you actually are making it clear enough for the judge, for the investor to understand how you're going to make money. And it is a little bit of a snapshot and art of not putting too much detail, but making sure you've got it succinct enough to understand, right? Like that matzah example, in my mind, is as simple a model as you can get, but is elegantly great, right? Because it's so easy for somebody to wrap their head around. That may all that you really need, coupled up with a model that says, well, how many cranberry farms are there? How much of this is bought? And then say, okay, if we build one extractor, we could do this in this year 1 and 2 in year 2, and a little bit of that story, and you might have a great story. Okay, so it's not easy. I will throw that out. That's why I'm presenting it this way. It's almost an art form. People think it's just something you hand to your accountant and you produce it. Frankly, I'm an accountant. Those are the worst models. It's this engineer who's really thought it all out, or really knows the business and knows what's going to happen. And then writing a story and having a summary financial story that brings it all together. So that's, I'm hoping that I'm getting through. I hope to see some amazing financial sections. I'll leave it at that for that.
Okay. What if your business is at the startup phase or prototyping stage? How would one do a projection?
Those are the easiest. Those are the Excel spreadsheets, right? World's your oyster. Just start thinking. Let's start. When's the first one going to be built? When are you going to sell it? Put on your spreadsheet. Today's date out to this date. When do you need to raise the capital? How much? Like, this is building your business in Excel first. If you can't build it in Excel, good luck doing it in the real world. So But yet so many people just start doing it without spending any time in Excel. That's why the engineers, they don't build anything without planning it out. And most of them are phenomenal in Excel. Some of the best financial models you'll see, like the resource sector, you know, big mines, biotech companies, these companies have amazing financial models. So yeah, if you're at the early stage, you just got to think it out in advance, make it up. It's all just your best estimate. And then as you produce it and you bounce it off people, produce it first, get feedback. That's a part of this journey in the competition, is getting that kind of feedback. Take it for what it is, make it better each time. That's all.
Yeah, I think it's about making the numbers both defensible and believable, because if they're not, then people will not believe the rest of the story. So
yeah. Exactly.
Okay, a couple of people in biotech hardware, they're asking kind of related questions. One says, I'm trying to figure out what KPIs I should use as a startup in biotech. Can you point me in the right direction? And then Christine also has a bit of an add-on on that. Like, how do we build models to get us the profitability when with a hard tech biotech company, there's long dev cycles, sales cycles, and, you know, they think they'll need to raise to profit of, you know, $50 million. So, you know, how do you respond to this sector?
Yeah, no, biotech. I've been in a lot of biotech companies in my career, like Medicena, which is a big NASDAQ. I was the founding CFO here in Vancouver. Fahar's business doing extraordinarily well. And it was a therapeutic, has to run its full course of the clinical trial process. But you got to know, what's your indication? How big is that market? What are the competitive therapeutics on the market? What are they selling for? What percentage of that market is? Back out, whatever, 7 years, 12 years, whatever it is, to bring it through, you know, your phase 1, 2, 3. You might get bought. You might get bought well before you ever generate any revenue, right? That's resource companies, junior resource and biotech companies often never generate a penny of revenue before they're bought. But you got to know why you're building it in the first place. And I've been through, well, we're involved with Racavina Therapeutics that went public. Similar, you know, startup, well, not startup, it's a longstanding technology brought up from Palo Alto. But we needed to dig in, like, where is this going to be once it's run its full course, FDA approved, out in the real world, being bought? It's often overlooked, I'll be the first to admit, and it's complicated, right? Those are sometimes the more complicated financial models, but it's the same exercise I just described. It's just a longer window, and you probably have to raise $150 million to get it through phase 3 or what, you know, whatever it is. Like, it's a different story. The numbers are just bigger, and it takes longer. That's all. Fundamentals are still the same.
All right, it's 2:00. So if anyone has to leave, please do. Maybe Sean, if you got maybe 2-3 more minutes, we'll just finish off these questions and then
sure.
We'll take
Happy to stay. Yeah.
Okay, great. I know you've got lots going on too. But for everyone who has to leave, thanks for joining us. Sales is next week, so I hope to see you then on Wednesday. Here's a question. Would you or Tandem have any Excel template of this projection slide or anything else?
Yes, yeah. No, I'm happy to send through some of the samples that we've shown here that you can kind of dig into. I will say that this produces monthly financial statements, balance sheet, and cash flows is the template that we'll send across. The most important one, though, is the sales, like digging in on what it is that you're actually selling and connecting that to your financial model that produces the hockey stick, etc. So, but yes, happy to share that with Angie, and anybody who needs that, we can translate that through. And if you need help, that's what our extended network is happy to help you with that too. So
awesome. Just a quick question for clarifying. What is the EBC qualifying ratio referred to?
Oh, yeah. I threw that in there. Actually, there are a few more slides I threw in that are all like the things that you absolutely have to do as a BC startup. But so EBC is eligible business corporations. That's, I think, item number 1, which is, did I have one on here? Oh yeah, there are, I forgot about these. But anyway, so eligible business corporations, if you're registered as an EBC, it's very easy. It's like a 2-page form to submit along with your executive summary, and you have to have raised $25,000. And suddenly, if you qualify in one of 6 categories, like technology, manufacturing, clean tech, tourism, a couple other categories, the British Columbia government will give your investors 30 cents on the dollar for their investment in your company. So if you were to qualify, which doesn't take too long, 7-day turnaround, not too hard, as long as you do truly qualify, what they look for, say for your R&D in that example, you have to be spending at least 50% of your spend on R&D activities over the period of coverage in order to qualify as an EBC. So that ratio is built into that model to give you a head start on making sure that you actually qualify under that program. Because when an investor writes a $100,000 check to your business and they get $30,000 back when they file their personal tax return, that gives you a big leg up on somebody who doesn't have that.
All right, 2 final questions. Marnie is asking, and I know she's got an agri-tech company, when is a smaller raise acceptable versus the raise that gets you to break even?
Smaller raises are no problem at all. What I was saying was that make sure your financial model gets you to that point in time. You should have some sense of what the total raise will be. And then it's almost something that's best done in conjunction with your investors, right? Oh, we could raise this amount to get us there. We've chosen to break it up to reduce the risk to investors as well as to lift the value. So it's a little bit more of putting that story into context. Make sure you have a financial model that truly gets you to the point where you're completely self-sustainable. The issue is then, okay, let's get to milestone 1 first. We need $500,000. Let's prove this thing out, get this thing patented, whatever it is. Then we'll do another seed round. You might get to a Series A, meaning you're now dealing with a venture cap. They want a preferred share around a Series A, Series B, then if there's follow-on. But it's a little bit of painting that picture. And it's not necessarily suggesting you're going to raise it all on day 1. It's just to make sure your financial model sees it right through to that long-term tail.
All right, and last question, and then we're all done. I'll ask the question, but it really associates to how simplified do I have to go? So for Serge, they say our software uses social science theories and emerging technologies like machine learning and sentiment analysis. How should I keep things for investors?
Yeah, AI companies are hot and heavy. I've been dealing with quite a few of them. That side of the technology is usually tied to some sort of competitive advantage at the end of the day or some time savings. You need to think about how does that story ultimately become revenue, right? What you're selling, Meta Optima, take for example, another one. I was the founding CFO for Meta Optima, which is another company here, which is deep in AI for dermatology. So yes, our technology was amazingly complicated, but at the end of the day, it was subscription and a device that got sold, mostly to Australians, of course, and clinics down there, but now kind of globally. So it's not so much the deep learning, the machine learning element, which is obviously very complicated, but it is translating how do we use this technology to generate revenue? So that's where you need to take the story.
Great. Okay, I think we'll call that a wrap. I've put Sean's company Tandem in the chat, a link there if you guys want to get in touch. I think there's resources on there as well. And otherwise, thanks for staying. And thank you, Sean, for spending time, and especially on April 29th. So appreciate that.
No problem. Yeah, no, anybody, honestly, if you've got a model, make sure you're getting someone to check it over. We do have quite a few resources and quite a few that are even on even how Red Thread, our venture arm, is quite willing to spend some time. So I'm really enthusiastic to hope the financial models this year are better than perhaps they have been in the past. So don't be afraid to reach out to some resources because we're here to help you. Where it's at the end of the day, if the BC venture world gets bigger and better because people have better financial models, we'll all benefit from it, right? So maybe we'll invest into a couple of the ones, right? So that's the goal at the end of the day.
Awesome. All right. Well, everyone, have a great afternoon. Thanks for coming. Sean, you're getting lots of thanks in the chat. So,
oh, great. Thanks,
thank
everyone. Have a great
great
rest of the week.